Hola! It's me, Dara. I am looking for my friend Dora. She told me she'll go to the capital market to invest in stocks. But I don't know where that is. Oh, if you are wondering, a capital market is a type financial market. I know where the financial market is, but it is just too big to find her there. Do you want to know more about financial markets? Maybe we should go to an adventure. For me to find Dora and for you to learn more about financial markets. First, I'll tell you what a financial market is. Basically, a market is a place where buyers and sellers interact. So, a financial market is any marketplace where buyers and sellers participate in the trade of assets, such as equities, bonds, currencies, derivatives, and many more. Are you ready for our adventure? But first, we'll need a guide. Oh, I know exactly who to call.
This is the map of the financial markets. First, you'll go to the money market, then to the insurance market, then to the interbank market, to the derivatives market, and to the largest forex market, to the commodity market, and to the spot market, straight to the futures market, and finally, the capital market where you can find Dora. Good luck on your adventure!
Money market. Money market is a segment of the financial market that trades highly liquid and short-term maturities. Here happens the short-term borrowing and lending with the maturity of less than 1 year. Money market doesn't have a physical store. Instead, it is an informal network of banks and traders linked by telephones, fax machines, and computers. Money market does not require registration with the Securities and Exchange Commission. Some examples of money market instruments. Number 1. Treasury bills or T-bills are short-term notes issued by the government. They come in 3 different lengths to maturity: 90, 180, and 360 days. The 2 shorter types are auctioned on a weekly basis, while the annual types are auctioned monthly. Number 2. Certificate of Deposit or CD is a certificate issued by a bank to a person depositing money for a specified length of time. A person lends money to a bank for a fixed period of time, and in exchange, the bank agrees to repay the money with a specified interest at the end of the time period. Number 3. Commercial paper. Commercial paper is an unsecured, short-term debt instrument issued by a corporation, typically for the financing of accounts receivable, inventories, and meeting short-term liabilities. Maturities on commercial paper rarely range any longer than 270 days. Commercial paper is unsecured, meaning buyers have no claim on a company's assets if the company fails to pay up at maturity. Therefore, only firms with good credits can successfully sell commercial paper.
Hi, I am Mrs. Garcia. I am interested with engaging in the financial market. However, I am planning to pull it out too as soon as I am finished with looking for my family's new home, and that is approximately before the end of the year.
Mrs. Garcia would most likely participate in the money market. Since the funds are highly liquid, it will be easy for her to pull out when she needs it. That's why many investors put their cash here in a short period of time, and I think she should park her money here while looking for a home to buy. Now that you know more about money market is, let's proceed to our next stop. Do you know where our next stop is? You're right! The insurance market.
Insurance market is a financial market where buying and selling of insurance happens. And insurance is the means of providing protection against possible eventuality. You can insure anything that you have insurable interest with, meaning you'll suffer from a great financial loss when it is damaged. It can include your car, your business, your house, actually even yourself or your family members. There are two categories of insurance, the general and the life insurance. The primary difference between general and life insurance is that life insurance protects against life, whereas general insurance protects against loss or damage to an asset. How does life insurance work? An insurance company pulls money from the people who are insured. It is called the premium, which is paid either monthly or annually. The insurance company only gives out the money when the insured asset is damaged, and the money they give out is called the claim. So how does insurance company earn their profit? Remember that not all insured gets their claim because not all insured assets will be damaged inside the contract period. So premiums minus the claims is the profit of the insurance. And that is a pretty big profit when most of the insured doesn't get their claims.
Hi, I'm Greg. That red car is mine. It is insured in iChoose.ph, a local car insurance company. My deductible is 20,000 pesos, which is the amount I'm willing to give out of my money for the repair of my car if ever it gets damaged. And the expenses exceeding that amount will be covered by my insurance company. Oh well, I think I have to file a claim now. Bye.
Now let's go to the third financial market. Can you guess what it is? Yes, it is the Interbank Market.
This market I'm not really familiar with. I know the name, but I'm not sure how it works.
Hi, I am James C. Crown, Director at JP Morgan Chase & Company, which is an American multinational banking and financial services holding company headquartered in New York City. Sorry, but I heard that you don't know much about what an interbank market is. The interbank market is the global system or network where banks and financial institutions trade currencies between themselves. The players in the interbank market are commercial banks, investment banks, central banks, hedge funds and trading companies. Ordinary individuals like you are not one of those who can invest money in an interbank market unless you own a bank or any financial institution.
I suddenly remember the term that I just heard from the employee of a bank where I went yesterday. Can I ask what an inward arbitrage means?
Oh, good thing you remembered that term. I was just about to share that to you. A form of arbitrage involving rearranging a bank's cash by borrowing from the interbank market and redepositing the borrowed money locally at a higher interest rate. The bank will make money on the spread between the interest rate on the local currency and the interest rate on the borrowed currency. For example, assume an American bank goes to the interbank market to borrow at the lower euro-dollar rate, and then deposits those euro-dollars at a bank within the US. The larger the spread, the more money that can be made.
Oh, that is awesome, sir. Thank you for conversing with me. I gained knowledge talking to you. Till we meet next time, sir.
No worries. It's my pleasure. Take care.
Woo! I learned with you on that. It's amazing, right? Now, let's proceed to our next stop. I think it is the derivatives market because I can see a contract on the map. A derivative is an arrangement or instrument such as a future, option, or warrant whose value derives from and is dependent on the value of an underlying asset. Derivatives market is a platform or the financial market for derivatives, financial instruments like futures contracts or options which are derived from the other forms of assets. Another term you should be familiar with is the collateral. It is something pledged as security for repayment of a loan to be forfeited in the event of a default. I'll give you an example. Mr. Badilla is going to sell one of his 3 hectares farmland of crops to his cousin Peter. They both decided to have an agreement for the arrangement of selling the land from the owner to the new owner and let both parties know and be aware to all the contractual conditions before they sign the agreement papers. Written in the contract are all the conditions that both parties have agreed together with the specific date of payment and the amount and also the collateral items. They have decided that within 7 years, Peter must have paid the agreed amount of payments already, and if Peter didn't make it to pay on time, in exchange of the money he didn't give yet are the assets or the collateral that guarantee Mr. Badilla that he will not lose a lot of money just because Peter can't pay him. Now, maybe we can go to the biggest financial market on the map. Do you know what it's called? You're right. It is the foreign exchange market. Foreign exchange market, also called Forex Market or FX Market, is the market in which participants are able to buy, sell, exchange, and speculate on currencies. It is considered the largest financial market in the world.
My aunt came home from her business trip in America and she gave me $5. I think of keeping $1 as a collection but wanted to spend the other 4. But how could I? We are in the Philippines, so I can't.
Friend, don't you know that money exchange establishments like banks, commercial companies, central banks, investment management firms are all over the place?
Really? But how much money could I get from exchanging these dollars to peso?
I'm not sure. It depends on the value of a country's money.
You think we could ask right now? If $1 can be swapped to peso in a high value, I'll grab the opportunity and exchange since the money is with me.
I don't think we are able to exchange it today. It's Sunday. As far as I know, it is open 24 hours a day but only for 5 days a week. And a piece of advice, if the peso value is too low at this point, you might want to consider not exchanging it yet because the value keeps changing.
I think I'll try tomorrow. I'll ask for assistance so I can know whether it is high or low at this point. By the way, thank you for giving me a useful information. By the way, how did you know all of this?
Sometimes, I help my sister review in banking and finance.
Wow, that's cool! Thanks again, friend.
You're welcome.
Forex market really is interesting. Now, let's go to the next financial market, which is the commodity market. Before we discuss commodity market, first let's find out what commodity means. Commodity is a raw material or agricultural products that is traded in large quantity on an exchange. The orange juice on your breakfast table, the gas in your car, the meat on your dinner plate, and the cotton in your shirt are all probably interacted with the commodities exchange at one point. A commodity market is a place where buyers and sellers can trade any homogeneous good in bulk. Two types of commodities are being traded in the commodity market. One is the soft commodities, which are the agricultural products like potatoes, wheat, and other root crops, and livestock are the domesticated animal that are raised from agricultural place to produce milk, eggs, leather, and wool. And the second one is the hard commodities, also known as mined and extracted products from the internal earth, like oil, copper, or gold. Now we can go to the next financial market, which is related to the commodity market, the spot market.
I am Lily Cruz. I want to buy gold as strong and indestructible like me, and I want a fast transaction. I am ready to pay on cash.
A spot market is perfect for Lily Cruz because the spot market is a financial market wherein your assets or financial instruments can be traded on the spot or in an immediate delivery. The spot market is also referred to as the physical market or the cash market because of the instant and immediate pace and movement of orders at current market prices. Spot markets can be organized markets or exchanges or over-the-counter markets. Organized markets or exchanges are highly organized markets that bring together dealers and brokers who buy and sell commodities, securities, currencies, futures, options, and other financial instruments. Over-the-counter market provide trades that happen directly between a buyer and a seller. Now we can go to our second to the last financial market. Do you know what it is? Yes, it is the futures market. You're getting good in the financial markets, ah? The futures market is a centralized marketplace for buyers and sellers from around the world who meet and enter into futures contracts. A futures contract is an agreement to buy or sell an underlying financial instrument or commodity at a specified future date and price. Two main participants of futures market. Number 1, hedgers. Futures contracts can be very useful in limiting the risk exposure that an investor has in a trade. The main advantage of participating in a futures contract is that it removes the uncertainty about the future price of an item. By locking in a price for which you are able to buy or sell a particular item, companies are able to eliminate the ambiguity having to do with expected expenses and profits. Number 2, speculators. A speculator is a person who trades derivatives, commodities, bonds, equities, or currencies with a higher than average risk in return for a higher than average profit potential. Now let's go to our final destination. I can't wait to see Dora! Capital market serves as a channel between suppliers of capital and users of capital. It is an institutional provider to borrow and lend money for a longer period of time, wherein investors play the role of lenders in the capital market, while business units and corporations play the role of borrowers in the capital market. There are two types of capital market. First is the bond market. Second is the stock market. Let us first define what is bond. A bond is a debt investment in which an investor loans money to an entity, corporate or governmental, which borrows the funds for a defined period of time at a fixed interest rate. The bond market, also called the debt market or credit market, is a financial market in which the participants are provided with the issuance and trading of debt securities. Buying bonds is safer than buying stocks. With bonds, investors only earn interest rather than profits. If a company goes into bankruptcy, it pays its bondholders along with other creditors before its stockholders, making bonds arguably safer than stocks. Another part of the capital market is the stock market, where Dora is really into right now. Stock markets allow investors to buy and sell shares in publicly traded companies. They are one of the most vital areas of a market economy as they provide companies with access to capital and investors with a slice of ownership in the company and the potential of gains based on the company's future performance. This market can be split into two main sections: the primary market and the secondary market. The primary market is where new issues are first offered, with any subsequent trading going on in the secondary market. Hey look! There's Dora!
Hey, I just did another investment on a famous company called Starbucks. I am now currently invested on two companies. I am so happy because they are doing really good right now.
But please be prepared for the possible risk, Dora. Investing in stock is really risky.
I know. Don't worry. I am keeping track of my stock. I will sell them on the perfect time.